In this week's video, we'll review the latest charts to help us answer the question, is this the beginning of the end for the stock market bulls? In last week's video and in numerous videos in the past, we have used this slide to make the following point. And we know with 100% certainty that even if good things happen between point A and point B, there is going to be periods of gut-wrenching volatility. It's probably fair to say that the last 5 trading days could be classified as gut-wrenching volatility. Covering the previous slide on a regular basis helps set proper and realistic expectations. The same can be said for the September 24th, 2018 short takes post that reiterated the following points. Since one of the hardest things to do is sit tight during normal volatility that regularly occurs within the context of a long-term bullish trend, it can be helpful to understand areas of possible support below the market. In that same post, markets often have give-back periods within the context of an existing trend. For us, the moral of the story is there are numerous reasons to be patient during 100% normal and to be expected volatility within the context of an existing and ongoing uptrend. And in parentheses, until the hard data says otherwise. Here's the chart that was included in that post on September 24th. And here's the same chart as of the close on October 12th, 2018. Given what we know today, and we'll continue to take it day by day, this looks like a 100% normal and to be expected retracement of this A to B move. In last week's video on October 4th, we noted that there was some white space between price and the moving averages, and that we shouldn't be particularly surprised if price came back down towards the moving averages in between 28.20 and 26.90. The concept of revisiting the moving averages aligned well with the concept of a normal retracement of an A to B move. If we fast forward 1 week, we see that the market has done a nice job filling the white space between price and the moving averages. And we can also see, as of the close on Friday, October 12th, 2018, our generic and for illustrative purposes only moving averages, this really doesn't look anything like this, and this really doesn't look anything like this. Blue, the fastest moving average, is still on top. Here, it's moved from the top to the bottom. The slopes of the moving averages, for the most part, are all positive. Here, the slopes of the moving averages are all negative. Is it possible that this morphs into something like this or this? We know the answer is absolutely positively yes, but it hasn't happened yet. And in past videos, we have shown via numerous historical examples how dangerous it can be to extrapolate in either direction. So we shouldn't be extrapolating these moving averages in this direction, and we definitely shouldn't be looking at this and saying this is rolling over and this is going to morph into something like this. Under our approach, the proper way to use this chart, the only way to use this chart, is to say this is what the chart looks like today. These are the facts that we have in hand today. And then we ask the question, are we allocated properly based on these facts? I'm going to estimate that somewhere between 90 and 95% of the charts and the moving averages that we show in these videos are not used by the market model. We use generic moving averages to illustrate basic concepts used by the market model. In this case, we're using the generic and for illustrative purposes only 100 in orange, 200-day moving average in pink, and the 300-day in green. And you can see, despite the fact that the fundamental issues of the day and valuations were quite a bit different in 1929 relative to the fundamental issues of the day in the year 2000 and valuations in the year 2000, and the same can be said for this period here. The technicals and the fundamentals are materially different in 2007 than they were in 1929. However, the look of a trend rolling over is very, very similar. This is what it looks like when the net aggregate opinion is bullish. This is what it looks like when the net aggregate opinion is mixed. And this is what it looks like when the net aggregate opinion of all market participants regarding all subjects, any subject that you can think of, and regarding any time frame that you can think of, from the shortest to the longest. This is what the net aggregate opinion looks like when it has flipped over to a bearish bias. You can see it looks very, very similar in all three cases. Therefore, this is the look that we want to avoid. Orange, the fastest moving average on the bottom, and the slopes of all of the moving averages are rolling over. How does the same chart look after a very difficult 2 weeks in the S&P 500? The answer is it unequivocally and unquestionably looks more like the constructive left side of this chart and more like the constructive left side of this chart. And it actually doesn't really even look much like this chart because this is an indecisive look with a lot of jumpiness in the moving averages here. This is a stronger trend here. It looks more like the strong trend here or the strong trend here before it starts to wane. As of the close on October 12th, 2018, orange, the fastest moving average, is on top, and the slopes of all three moving averages are positive, and all three moving averages are printing new all-time highs. We're not saying anything like that in here. We're not saying anything like that in here. And we're not saying anything like that in here. And as we showed in last week's video, chart dated October 4th, in terms of our trend being extended, the present day really doesn't look anything like 1998. And the present day, as measured by Black ADX, really doesn't look anything, not even remotely close to the extended trend prior to Black Monday in 1987. Since we know technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior, and by definition, anything that creates a new chart pattern is something unusual, have our present day charts morphed from a look like this, which frankly is a somewhat concerning look because of the volatility in these moving averages here, but this is still bullish. This is the concerning look that we want to avoid over here. Here's the rollover look for the S&P 500, 2007, 2008. Rollover look for the NASDAQ. And the bigger picture, just using the 200-day moving average from the year 2000 out to the bottom in calendar year 2009. This is the daily chart, the exact same daily chart for the S&P 500 and the NASDAQ as of the close on October 12th, 2018. And the charts speak for themselves. This is the chart of the Dow that we covered in last week's video. If we fast forward to the end of this week, you can see we still have a constructive and bullish look. And we still have the 50-day moving average holding above this period of consolidation. Here, the 50 is still well above a rising 200. And as we noted in last week's video, we've been using these concepts for quite some time, including using this chart here in a video dated September 1st, 2016. Why is that important? Because consistent methods help produce consistent results. And if we used a chart like this as bullish evidence in September of 2016, then number one, after a very difficult period in the market, we should check on it to see if it's flipped from bullish evidence to bearish evidence. Because the second important factor is, if it can help us on the bullish side and it's really effective, it should help us on the bearish side as well. So here's a look of our 30, 40, and 50-week generic and for illustrative purposes only weekly moving averages that we covered last week. This is the look here. A tight cluster with them rolling over. Blue eventually moves to the bottom. After we could see all of this, the market lost an additional 47%. And in this case, after we could see the full bore bearish look, it lost an additional 52%. Do we have this type of look in the present day? The answer is no. October 12th close. Here's a zoomed in view. Remember last week we said 5 things have to happen to negate the bullish signal. Number 1, blue has to drop below red. Number 2, blue has to drop below green. Number 3, the slope of blue, red, and green, all of them have to roll over. How many of those 5 things have happened as of the close on October 12th? The answer is 0. Slope of this line is still positive, the slope of this line is still positive, and the slope of this line is still positive. And in fact, the distance between blue and green tells us, for the most part, that we still have a relatively strong and sustainable trend. A little hiccup like this is no different than a little hiccup like this. This didn't mean that the downtrend was over, and this look here doesn't tell us that the uptrend is over. All of that is to be determined. We have no preconceived notion as to what this chart's going to look like in the future. We only concern ourselves with the facts in front of us. Now here's some weekly moving averages that are used by the market model. And the only questions the model asks have to do with, is blue above red? Is blue above green? Is blue above pink? We're not concerning ourselves with slopes here. This is moving average crossovers. You can see in the peaking process in 2007 several things. Number 1, blue, the fastest moving average, makes a discernible and measurable lower high when the S&P 500 peaks. Number 2, we get a tight cluster look in a rally attempt that fails. We don't go on to make a higher high. And then we get another tight cluster look and get 3 bearish moving average crossovers. And all of that occurs soon after the S&P 500 peaks. We don't really have any of that in the present day. Do we have a lower high? Nope. This is a much higher high relative to this high. Do we have a second tight cluster look yet? We don't. There's a lot of white space still in here. And do we have any negative answers to our questions? No. So in this case, from the model's perspective, the only thing it cares about is binary questions. It doesn't care about the look of the chart or anything. All 3 of these questions are coming back bullish. It's either a 0 or a 1. Same moving averages here, similar concepts. If you know your market history, you know the S&P 500 really started to tank after September of the year 2000. We go from yes, 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 quickly to no, no, no. And in the present day, we have yes, yes, yes. If we compare the present day look to 1996, it's pretty fair to say the present day looks more like 1996, which is a sustainable trend relative to this look here and relative to this look here. We covered these charts on short takes a few weeks ago. This is growth-oriented S&P 500 relative to long-term treasury bonds, which is SPY, relative to TLT in the ETF world. This is the 22-week moving average here. The S&P 500 peaks right here. When the market peaks, we can see a discernible and measurable lower high in the ratio. And we can see a 22-week moving average that has flattened out. Price has already moved below it, and now it's trying to recapture it, and you can see it fails almost immediately after the stock market peaks. Everything on the right side of this chart doesn't look anything like this. How does the exact same chart look today? Do we have a discernible lower high? Have we been below the 22-week moving average? And is the 22-week moving average rolling over in a concerning manner as it did in October of 2007? The answers are no, no, no. And we don't have any of those concerning looks on the exact same chart as of close on Friday, October 12th, 2018. In fact, we have the ratio above an upward sloping 22-week moving average, and we're still holding the breakout in the ratio relative to this multiple month period of consolidation. We can make an argument that this is some type of retest here coming back toward the box, and we know that a retest can either come back toward the box and move in this direction, come back to the box, move in this direction, come back in the box, scare us all, and then move in this direction, or the breakout can fail. All of that is to be determined, but what's not to be determined is the look of this chart, and it still leans bullish from a probability perspective. If you're a client and you looked at your history file this week, you know that we took no action this week. How did we determine that when we have gut-wrenching volatility? This is a screenshot of the trend strength portion of the market model. So when we say that Kathy is updating the trend strength model, this is what she's doing. She's physically looking at charts and answering binary questions. Why do we like to do it that way? Because it forces us to look at the charts, which is important. If you build a black box, number one, you'll forget what's in the black box. And number two, the visual evidence, as we show in these videos, is powerful. The numerical evidence allows us to track a significant amount of information and do so in a way that we're not overwhelmed and confused. We can boil it down to one number, and that number can help us make prudent decisions. This week, the decision to do nothing ultimately boiled down to a simple if-then statement in the market model. It basically said, if this and this are both true, don't do anything. This question here is the trend strength model. So this one number here is a summary of the answer to 207 binary questions. Now imagine it's Thursday or Friday, you've got red all over your screen. Imagine if you tried to look at 207 items, remember them, and then try to make a decision on the fly while the market's open. This is also one number that has numerous data points. It is related to the long-term health of SPY. And ultimately, this is saying if we have observable and hard data-based strong trends, we should classify it as volatility to ignore. Why? Because ultimately, all of those numbers and all of the zeros and ones and all of the calculations and formulas and if-then statements really help us answer one question. Does this look like a pullback within the context of an ongoing bull market? If the answer is yes, if we're in a bull market, we know with 100% certainty in a bull market that all pullbacks are followed by higher highs. That's what bull markets do. From a big picture perspective, they make a series of higher lows and a series of higher highs. At some point, your hard data and your model will walk through all of this, look at it, and say, now the probabilities are such that this is volatility to respect, and we have to start migrating toward a defensive posture. The hard data and the charts and the moving averages and the risk on risk off ratios help us do nothing more than assess the probability of good things happening after this pullback relative to the probability of this being the early stages of a new long-term downtrend. And I can say unequivocally, this was not really even a close call from a data-based perspective. Mathematically, this week we were not close to having this tell us it's time to take action. And that speaks to the strength of the current trends, and it speaks to the facts that we have in front of us today. The facts that we have in front of us today. And this chart here is a proxy for the weight of the evidence. This is a proxy for the net aggregate opinion of all market participants. This helps us monitor and track the vote of the entire marketplace. And while the concepts that follow have absolutely positively nothing to do with our decision-making process, experience tells us that it's possible that a move like this could end up being similar to a move like this, where the S&P 500 futures went limit down after the Brexit referendum. Futures went limit down. We reversed soon thereafter and went on to print a higher high above this high and a higher high above this high. And it's possible, again, these statements have nothing to do with our process, that a move like this is similar to a move like this, including when the futures went limit down the evening of the U.S. presidential election, which is the evening of November 8th, 2016. And it's possible that a move like this will end up aligning with this quote from Market Wizards that we covered in 2016. I find that major trends are now frequently preceded by a sharp price change in the opposite direction. Major trends are often preceded by a sharp price change in the opposite direction. And if you know your market history, you know the market did not continue to go in the opposite direction. It went sharply in this direction. All of that is to be determined. Every chart that we've looked at in this week's video and every 0 and 1 in the CCM market model and every piece of hard data in the CCM market model is fully aware of and takes into account everything, including interest rates. There's nothing you can think of that the market hasn't thought of. And it should also be noted, there's nothing that says interest rates, even if they continue to move in this direction, are going to go straight up. You can make an argument that 10-year yields have some relatively major hurdles in front of them. Normal retracements occur in both directions. This is an A to B move. It's a fall in interest rates that occurred from 2006 to the low in 2016. This chart is as of October 8th. We have moved back and retraced 50% of this downward move. This is a 50% retracement. That's where we basically are now. And that happens to be the area where these trend lines, these downward sloping trend lines, come into play. We're not predicting anything here, but this just tells us to keep an open mind about interest rates running into some resistance in the short to medium term. What happens on this chart will have absolutely positively zero bearing on how we proceed. Why? Because all of this and all of this and all of this is taking that into account. And if it becomes a problem, which it may, the present day chart won't look like this. It will morph into something like this. We're really not looking at a chart like this very often. This is the chart that we're more interested in. The long-term breakout of stocks relative to bonds is still holding as of Friday, October 12th, 2018. And we know in technical analysis that anything that creates a new chart pattern is something unusual. Ratio comes up to this level and is rejected, resistance. Ratio can't even climb back to the same level and falls. Ratio comes back to the same level and breaks out. This is a new chart pattern relative to this, this, and this. And as we've covered in the past, this is a very constructive look with ADX here, telling us to be open to much better than expected outcomes on this chart here for several years. It's not a prediction. It's a probabilistic statement based on the facts in front of us. The ratio entered the box back in the mid-1990s, stayed in the box until calendar year 2017. The longer you go sideways, the bigger the move you can expect to get. And as we noted on Twitter this week, a move like this never feels normal when we're experiencing it in real time. You can find this tweet in our Twitter feed and click on this portion of the tweet to see the data from a MarketWatch article. Since 1928, the S&P 500 has logged a 5% decline about every 2 months and a 10% drop every 6 months. We have to have realistic expectations about 100% normal and to be expected market volatility. On average, the S&P 500 has experienced an intra-year decline of almost 14% since 1980, despite going on to post annual gains in over 75% of those 38 years. Higher volatility is not necessarily the boogeyman that it's made out to be. That is a point that we cover over and over and over again in these videos. Because if we don't have realistic expectations, it's going to be very, very difficult to stick with the system and stay invested when volatility inevitably rears its ugly head. So for all of us, including yours truly, if volatility continues, and that's to be determined, it's extremely important that we make a concerted effort to avoid these common missteps. We've been studying markets and market behavior here for a long, long time, and we are very confident in these 2 points. Traders and investors typically greatly underestimate in these 2 key market areas. Number 1, markets are frustrating, volatile, and difficult. And investors and traders typically greatly underestimate the strength of primary trends. Are we saying markets are easy? No. In fact, markets are very difficult, which is exactly why it can be extremely powerful to simplify by focusing on the primary trend and long-term probabilities. 1987 is an extreme example of these 2 points. At this point here, the S&P 500 falls over 20% in one day on Black Monday. It falls in October and doesn't right itself until December. Markets can be very, very volatile and very, very frustrating. But we can't underestimate the power and strength of the primary trend. Prior to Black Monday, the S&P 500 index, if we just owned the index, it gained 229% before Black Monday, and the primary trend reasserted itself after Black Monday, and the S&P 500 tacked on an additional 582%. We can add a third bullet point to the areas where investors greatly underestimate. They greatly underestimate the type of returns that can be generated during strong secular bullish trends. Our primary objective has to be, in a bull market, to make money. If we try to avoid volatility, reduce volatility, feel comfortable, if we're constantly worrying about protecting capital or beating the market, we're going to have a tendency to overtrade. And instead of beating the market, we will most likely significantly lag the market. Think of trying to avoid volatility, reduce volatility, feel comfortable, and protect capital when the S&P 500 logs a 5% decline about every 2 months and a 10% drop every 6 months. Or, in this context, the S&P 500 has experienced intra-year declines of almost 14% since 1980. So while all of these bullet points seem admirable at face value, they can be extremely counterproductive, because in many cases, the odds favor destroying value and capital rather than protecting capital. How does that occur? Overtrading, over-tinkering, over-fiddling. We've covered this concept in the past, but it's worth revisiting. The S&P 500 closed below its 200-day moving average this week. How concerning is that? This A to B period here, 2003 to 2007, gain between point A and point B, 77%. How many times did the S&P 500 drop below its 200-day moving average between point A and point B? The answer is 81 times. How many trading days between point A and point B ended with a close below the 200-day moving average? Answer: 186 trading days. Thus, how concerned should we be when an index, stock, or ETF drops below its 200-day moving average? The answer is, it depends. Context matters, and that's where the weight of the evidence comes into play. And the only way we can properly use the weight of the evidence is to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.